Finance is the lifeline of any business. However, finances, like most other resources, are always limited. On the other hand, ones are always unlimited. Therefore, it is important for a business to manage its finances efficiently. Let's see what some of the experts say about financial management. Financial management is the activity concerned with planning, raising, controlling, and administering of funds used in the business. By Gottman and Durgal. J.F. Bentley said that financial management is that area of business management devoted to a judicious use of capital and a careful selection of the source of capital in order to enable a spending unit to move in the direction of reaching the goals. Macy said that financial management is the operational activity of a business that is responsible for obtaining and effectively utilizing the funds necessary for efficient operations. So, if we simplify their definition, we can say that financial management is what financial managers do to achieve organizational goals and activities. Now, the question is, what does a financial manager do? A financial manager conducts some activity like financial planning, organizing, directing, and controlling organizational funds. It includes three important decisions, which are investment decisions, financing decisions, and dividend decision for a specified period of time. Investment decision includes working capital decision and capital budgeting decisions. Financing decision involves identifying sources of financing, determining the duration and cost of financing, and managing investment return. Whereas dividend decision involve decisions related to the portion of profit that will be distributed as dividend. Shareholders always demand a higher dividend, while the management would want to retain profit for business needs. Hence, this is a very complex managerial decision. Now, let's see an example of financial management. Suppose company X is willing to introduce a new product. For this, the CEO employs a financial manager to perform all financial activities. Now the manager has to identify the sources of funds needed for producing the new product. Then he should determine and evaluate the cost of financing. He will allocate the fund using financial planning, and after gaining profit, he will distribute the profit to the designated stakeholders. Now let's see the functions of financial management. First one is estimation of capital requirements. A finance manager has to make estimation with regards to capital requirements of the company. This will depend upon expected costs and profits and future programs and policies of a concern. Estimations have to be made in an adequate manner which increases earning capacity of enterprise. The second is determination of capital composition. Once the estimation have been made, the capital structure have to be decided. This involves short-term and long-term debt-equity analysis. This will depend upon the proportion of equity capital a company is possessing and additional funds which have to be raised from outside parties. Third one is choice of sources of funds. For additional funds to be procured, a company has many choices like issue of shares and debentures, loan to be taken from banks and financial institutions, and public deposits to be drawn like in form of bonds. Choice of factor will depend on relative merits and demerit of each source and period of financing. Fourth one is investment of bank. The finance manager has to decide to allocate funds into profitable ventures so that there is safety on investment and regular returns is possible. Fifth one is disposal of surplus. The net profit decision have to be made by the finance manager. This can be done in two ways. Dividend declaration. It includes identifying the rate of dividends and other benefits like bonus. Retained profit. The volume has to be decided, which will depend upon expansion, innovational diversification plans of the company. Sixth is management of cash. Finance manager has to make decisions with regards to cash management. Cash is required for many purposes like payment of wages and salaries, payment of electricity and water bills, payment to creditors, meeting current liabilities, maintenance of enough stock, purchase of raw materials, etc. Seventh one is financial controls. The finance manager has not only to plan, procure, and utilize the funds, but he also has to exercise control over finances. This can be done through many techniques like ratio analysis, financial forecasting, cost and profit controls, etc. Have a look at the importance of financial planning. First one is financial planning helps in ensuring a reasonable balance between outflow and inflow of funds so that stability is maintained. Two is financial planning ensures that the suppliers of funds are easily investing in companies which exercise financial planning. Third one is financial planning helps in making growth and expansion programs which helps in long run survival of the company. Fourth one is financial planning reduces uncertainties with regards to changing market trends which can be faced easily through enough funds. Fifth one is financial planning helps in reducing the uncertainties which can be a hindrance to growth of the company. This helps in ensuring stability and profitability in concern.